So coming to the types of options, we have a call option, and this is the definition of a call option, and we also have a put option. I have also put the definitions of both of them here on the board. But first, let's try to recollect what an option is. Okay, an option is giving the rights to buy or sell something at a specific price on a specific date. Okay, actually, we are trying to divide the buy and sell into two different types here. Call option is about giving the right to buy something, only buy something. Okay, and put option is giving the right to sell something. The other two parameters of specific date and on a space with a specific price is present in both these definitions. Okay, so a buyer of the call option has the rights to buy a particular stock at a specific price, and a buyer of a put option has the right to sell a particular stock at a specific price on a specific date. All right. Also, the buyer of a call option, what does he expect? He expects the price to go up, which means if you are bullish on a particular stock, or if you are doing the options trading with indices, then you are expecting the Nifty to go up. In such scenarios, you go and buy a call option. And when do you buy a put option? If you are bearish, which means if you are assuming that the prices of the stock or the indices is going to go down, then you're going to buy the put option. And is it all about just buying and of the call option and put option? No, you can also sell a call option and you can also sell a put option. Okay, so there are four combinations here. You can buy a call option, or you can sell a call option, and you can buy a put option, and you can sell a put option. So the general confusion starts when we talk about selling and bringing in both call and put, because they all act opposite of what they are actually intended to do. Okay, so don't worry if you are too confused at this stage. It will all be gradually cleared as you get into the next slides. Okay, I have put a small chart here for you to understand it better. What is buying a call option means? Buying a call option is buying the rights to buy something. Okay, and selling the call option means selling the rights to buy something. Okay, it might be tricky or confusing at the beginning, but once you get a hang of it, then you are actually clearing the very first basic hurdle in understanding the options and option trading. Okay, so buying a call option is buying the right to buy, selling the call is selling the right to buy. So here the common thing is call option means the right to buy something. Okay, either you can buy those rights or you can sell those rights. That is what the first two lines talk about. Similarly, buying a put option is buying the right to sell, and selling a put option is selling the rights to sell something. Okay, again, put means the right to sell. Okay, you have the rights to sell something, and either you can buy a put option or you can sell a put option. All right, we will again revisit the slide as after a few more slides to make sure that this information is clear to you before we go and proceed into the advanced topics of doing the strategies. All right, let's now get into just the call option and try to understand what a call option is and how to exercise it. Going back to the definition, a call option gives the buyer the right to buy something at a specific price within a specific time period. Okay, so a call buyer profits when the underlying stock increases in its price. So let's take the same example of the Reliance stock. The current market price is 2000 and we choose the strike price as 2100 itself. Okay, The contract expiry is end of the month, and let's assume that we are at the beginning of the month now, and the option premium is set at rupees 20. The lot size for Reliance is 250, so the entire premium that the buyer needs to pay the seller is rupees 5000. So the buyer of the call option pays rupees 5000 to the seller and makes the contract deal to buy the Reliance at rupees 2100 by the end of this month. If the market price of Reliance goes to 2500, then the buyer of the call option is making huge profits. Okay, so let's see the different scenarios here to understand what happens if the price of the Reliance share goes up or if it goes down. Who gets the profit, whether the buyer or the seller? Okay, so by the time of the contract expiry, okay, first let's see the first top section. If the Reliance price is at 2500, okay, so what is the strike price at which we did the contract here? 2100. And if you subtract the 2100 from 2500, you get 400 rupees profit per share. Okay, the buyer gets rupees 400 profit per share because the price of the Reliance share has reached 2500 by the end of the month. So he is making a huge profit here. So 400 rupees per share. So since it is dealing with one lot, we have to multiply rupees 400 with 250, and you're going to also subtract the rupees 5000 he paid as a token amount to the seller, which is 95,000 rupees is the profit that the buyer is going to make if the price of Reliance goes to 2500. What is the profit if it goes to 2600? Same math, and he would end up getting 1,20,000. The higher the price of the Reliance stock reaches by the end of the contract expiry date, the more profit the buyer is going to make. And whatever amount of profit that the buyer is making, that same amount is the loss that the seller is making on the other side. Okay, but say suppose the price of Reliance share is staying at 2000 or falling below 2000. Okay, say if it's at 2000 itself, so what does the buyer do? Of the buyer of the call option, what does he do? He will not exercise the rights to buy it at 2100, because he can buy the same Reliance share at rupees 2000 in the market. In the actual market, he can buy it at rupees 2000 itself. Why do he wants to exercise the contract which says to buy the Reliance share at rupees 2100? Okay, it would be foolish to do that. So he's not going to exercise it. All that he loses is the rupees 5000 he's paying as a token amount to the seller. He's going to lose that amount, and whatever the buyer is losing, that is the profit that the seller is making. So as you see, if the price of the Reliance stock is either rupees 2000 or 1900, or even for that matter exactly the same as the strike price, even if it is at 2100, even then the buyer is not going to make any profit here, because in the spot market or in the current market, he is able to get the same Reliance stock by the end of the month at rupees 2100. Then there is no difference, either you go and buy from the seller or you go directly buy from the market. So the rupees 5000 that he paid as a token amount, or the option premium to call it exactly, is the maximum loss that the buyer of the call option gets if in case the price of the Reliance stock stays either equal to 2100 or below 2100 by the end of the contract expiry date. Okay, so let's take a look at some of the common questions that you might have after listening about the call option. So the first question here is, does the strike price need to be greater than the current market price of the stock or the index in a call option? So in a call option, you have the right to buy something at a fixed price. Okay, so should I choose my strike price to be always greater than the current market price? Most likely, but it does not mean that you cannot buy a call option of a strike price that is lesser than the current market price. So, for example, the Reliance is trading at rupees 2000 as of today. You can also buy the strike price of 1900 or 1800 or 1700. The lower the strike price that you choose, the premium is higher. And why do you think the premium is higher? Because the probability of you selling the Reliance stock at the price which is lesser than the current market price is already reached, right? So today it is 2000 and you want to sell the stock by the end of the month at say suppose 1900, which means it is already crossed 1900. It's at 2000, so the rupees 100 is already there, which you can profit. Okay, so the premium for the 1900 strike price will be much greater than the premium that you pay for, say for example 2100, right? Similar to what we saw, or like what I've explained earlier, the premium as you go far away from the current market price, like 2100 or 2200 or 2300, the option premium gradually decreases. But at the same time, if you go on the left side, so from the current market price of 2000, if the strike price is say 1900, the premium is very high. And if it goes to 1800, it is even more high. Okay. So that probably answers the question here. So the next question is, the premium collected by the seller of the call option the maximum profit he can earn? Absolutely yes. This is what we have seen in the prior slide, where the maximum profit a seller can earn is always the premium he collects from the buyer. But the buyer has technically unlimited profit that he can earn if the market keeps going up. Yeah, as you see, the next question, how much profit can the buyer make, which is unlimited technically or theoretically for that matter. It doesn't mean that the stock can go up for ever or for a very long number within like say 30 days contract or something like that. So although theoretically the price can go up whatever it wants to, which means that the call option buyer can earn unlimited profit, and that will be the unlimited loss for a seller. However, if the seller is winning, then the maximum profit he can earn is just the premium he collects from the buyer. That's all. So by looking at this information, you might get a question that buying of call options is more profitable than selling of call option. Quite naturally, you might think this is true because the potential for getting unlimited profits is possible only by doing buying of the call options. But the maximum profit that a seller can earn is limited to just the premium he collects from the buyer. However, the reality is different from what the theory says. In the real world, the sellers actually make more profits than the buyers. And we will know why this happens and why you should prefer doing selling of options as the first choice rather than buying of options. There are certain scenarios or circumstances when you can opt for buying the options, but in most cases, you should always prefer selling of options in order to earn profits. You will learn about this more in detail as you go through the remaining part of the course.